All right, exam 3 review session. Let me go over one more time the structure of the test. So there are 25 multiple choice questions, again, from the last 3 chapters. And I had like 6 final tests, so to speak of, and I pulled questions from all of them to combine them to try and make them a good combination of fair and straightforward, understanding some of the changes in monetary policy and such. But if you study the last 3 chapters, you'll be in very good shape. And then I know I said in class that there's 2 free response questions. Uh, the first one about the WSJ Wall Street Journal video on 2% inflation, and the Wall Street Journal video on uh, the Fed actually operating at a loss currently, and how and why the Fed sometimes operates at a profit and sometimes operates at a loss, and sort of the economics of that. What I did was I broke those into 2 different questions. They'll still be worth 24 points total, knowing that like we'll just do 12 and 13. The 2% video is slightly shorter and there's not quite as much content as in the other video. But it just made sense to make them into 2 questions. So there are 3 free response questions, obviously. The first one's about the 2% video. Second one is about the Fed and its balance sheet and the reason why currently the Fed is operating at a loss. So make sure you review both those videos. And then the last free response question is what we'll cover last in our review session here. It's an application of the aggregate demand, aggregate supply model, and the use of monetary policy to address either inflationary gap or a recessionary gap, right? All right, so I think you know, I always tell students the best way to study for these tests is to study as if you weren't allowed to use your notes. So if you study as if you're not allowed to use your notes, and then you have your notes to sort of fall back on as a crutch, then you'll be in much better shape. So having said that, when we just looking at just this slide, we could cover, challenge yourself. I'll show you the ideas and the answers, but challenge yourself. We said, okay, what is money? And we talked about the idea of, you know, there's been 3 types of money over time: commodity money, commodity-backed money. So in the little anecdote about the goldsmith and the merchants, it started with commodity money with the gold, and they went to commodity-backed money when the paper receipts issued by the goldsmiths represented the gold. And now we work on what's called fiat currency. So understand that idea. It's a pretty broad idea, but challenge yourself right now and say, like, okay, what are the 3 functions of money? As you sit there in the review, can you write down all 3 functions of money? And can you give an example of those 3 functions in usage, right? So what are the 3 functions of money? And can you write down an example of all 3 functions? So if you can do that, you've studied some. So let's give you 20 seconds to just at least write down the 3 functions of money. Right? See if you can write those down. And then try, as you're writing them down, think of like an example of, this explains what we mean by this function, right? So what are the 3 functions of money? So you should have written down what? Medium of exchange, unit of account, store of value. Medium of exchange, unit of account, store of value. So whenever we use money to escape the cumbersome, unfriendly barter system, we're talking about money as a medium of exchange. And the beauty of that is it facilitates tremendous efficiency in terms of productive efficiency when it comes to individuals and geographic specialization of use of resources. So a good example, say, like, hey, look, whether it's I don't know, it's a car, or it's getting a trip to California on an airline. Whenever we state how much something costs in terms of that economic activity, money is being used as a medium of exchange. So it's okay, a new Ford F-150 is $45,000, right? Medium of exchange. Now, unit of account, think comparison, right? And there's two ways to think about this. You can think of it as straight opportunity cost. Either I can go to the movies for $20, or I can, go to the grocery store and get this mixture of milk, bread, and eggs for $20, right? So whenever you're using money as a way to compare the value of economic activities, goods, or services, or if you're using money just to estimate, like, okay, a college education costs this much money. So you're like, okay, relative to, I could have taken the money and I could sort of buy stocks, right? And think like, okay, I could buy this basket of stocks, or I could buy a college education, right? So whenever you use money as a comparison unit of account. And then finally, money should transfer purchasing power from today to tomorrow. So store of value. Now, the reason I go over these, looking over the multiple choice questions, there are at least 3 questions associated with this slide. So if there's 25 multiple choice questions, 1 out of 8, that's right there. You got like 1/8 of the multiple choice questions almost from this slide alone. So make sure you review the uh, 3 functions of money. I don't remember there's a question about liquidity, but it's a pretty straightforward idea. How quickly can an asset be converted into purchasing or exchange for goods and services? Money is the most liquid of all assets. Another question I did ask is this equation down bottom. The value of a dollar varies inversely with the price level. So when you talk about like, what gives money value? Well, fiat currency only has value for 3 reasons. The government makes it legal tender, right? There's a willingness for people to accept it in terms of exchange. So the acceptability is huge. And then the relative scarcity, that's the most important of the 3 reasons why fiat currency has value, or it serves as money. But when you say, you know, the dollar versus inflation, the dollar versus changes in the price level, the greater the inflation, the less purchasing power a dollar holds. So if year over year, when you look at that period of time from the Great Recession, we'll call it 2009, all the way to 2020, there was very little inflation. Inflation averaged under 2% for that, nearly 20-year stretch. So over that period of time, the value of a dollar didn't really depreciate much in terms of purchasing power because there wasn't much inflation. But in 2022, we had 9% inflation. So literally, between 2021 and 2000, let's say the end of 2021 and the beginning of 2023, your dollar lost 9% of its purchasing power because price level inflation went up. So the value of a dollar varies inversely with price level. There is at least one question about M1, M2, maybe a couple questions. I don't remember, at least one. So, you know, cash, is that M1 or M2? Uh, Checkable deposits, money in checking accounts, is that M1 or M2? Now be careful because cash slash um, checkable deposits, those are part of both M1 and M2. But money market mutual accounts, and those near monies, they're only part of M2. So review the definitions of how we counted together the money supply. That stuff's pretty straightforward. All right, let me see what else we have here. All right, from this, so you definitely know the basics of the money markets. I definitely know the basics of the money market. Matter of fact, I put it together. What the heck is this? Yeah, when you look at this, all right, so here's the money market graph. Make sure you understand what goes into the transaction, sorry, what goes into the total demand for money. It's partially made up of the transaction demand for money, partially made up of the asset demand for money, right? Supply of money is controlled by our friends at our nation's central bank, aka the Fed. Right, so there's your demand and supply. Remember, on the horizontal axis, we're measuring quantity of money demanded and made available, so supply and demand. And on the vertical axis, we're measuring the interest rates. So demand for money made up of transaction demand for money and asset demand for money. When you look at the downward sloping demand curve, think, all right, we need money to facilitate every economic activity. That's the transactional demand for money. Every time an economic transaction takes place, we need money for that. So therefore, the transactional demand for money varies directly with nominal GDP. Asset demand for money, think opportunity cost of holding money. Think, okay, if there's a real low interest rate in the economy, like that period of time I just described, where the interest rate, even on money markets, was less than 1%, there's very little opportunity cost to holding money as an asset. But during the last little stretch here, especially from 2023 through 2024, they've come back down a little bit. Interest rates on, we'll call them low risk investments, like a money market, went up pretty decently. So you get paid for basically parking your money in a money market. So the higher the interest rate, the more the opportunity cost of holding cash money as an asset. The lower the interest rate, the less the opportunity cost. So the asset demand for money varies inversely with the interest rates. And then simply understand, like, okay, bring together the demand for money, supply of money, equilibrium in the money market tells us the interest rate. All right, now this sort of jumps ahead, but it's super important to understand this. And it doesn't even matter if we're operating with limited reserves or ample reserves. The idea is just pretty darn straightforward. Here's the current interest rates. Okay, 5% interest rate. And all of a sudden the economy heads into that inflationary period of the mid 70s or the early 80s, right? Even before the time like I knew what the hell I was like a little child in the 80s. Right. So what does the Fed want to do in response to a period of inflation? Well, they want to slow economic activity. How do they do that? They raise the interest rate. Well, how do they accomplish that? If the Fed reduces the money supply, they will push up interest rates, which will stifle some economic activity. Then like, okay, what about that period of time in 2000, like 1991, there was a mild recession. 1982, there was a recession. 2008, there was a recession. And of course, the pandemic. During an economic contraction, when business activity is pretty slow, consumer spending is weak, the Fed wants to encourage more borrowing and spending. In that case, the Fed will increase this money supply, bring down interest rates, all right? And more about that later. But make sure you understand the basics of the money market and the idea of how changes in the supply of money affect interest rates. All right. What's the next book stuff? Yeah, and the structure of the Fed. So I think there's at least one or two questions about the structure of the Federal Reserve. So no, like, okay, I don't think there's anything about like, the what year the Fed was founded, 1913, but the Board of Governors, you got 7 members of the board. They're elected to 14-year terms. One of those positions comes up every 2 years. So there's this tremendous consistency among the board members. You got 12 regional banks across the country, right? So 5 of the presidents of the regional banks. So New York all the time, and then the other 11 rotate, the other 4 positions rotate. Together, those 7 people on the board, plus the 5 voting members of the Federal Reserve Bank presidents, they make up the FOMC, right? The Federal Open Market Committee. So when you look at, oops, sorry, I'm gonna skip the slide. When you look at the structure of the Fed, know that it's the FOMC that ultimately gets together every 6 weeks and determines monetary policy. Now, they don't have to wait 6 weeks. In 1987, there was a crazy stock market crash, and they had an emergency meeting that night. So the Fed can operate quickly if necessary, but during normal times, they only meet every 6 weeks. At the end of the day, she or he, whoever's the Fed chair, they're the buck stops here person. They get to decide ultimately what happens with the Fed's policy and interest rates. Now, a couple questions about functions of the Fed. When you look at this list of Fed functions, go to the bottom of the list and say, look, that's the most important one. At the end of the day, some of these other functions are important, but they all revolve around the Fed's most important reason for being in existence, and that's to control the nation's money supply. And you're like, oh, what do you mean control the nation's money supply? We just showed you on a graph. If the Fed wants to stimulate economic activity, they'll make more money available in the economy to increase the amount of loans, to push down interest rates, to stimulate economic borrowing and spending. Right? The Fed wants to slow economic activity because of some worries about inflation. Right? The Fed will soak out some of the liquidity in the system, push up interest rates. The other functions are important. Issuing currency, setting the reserve requirement. We'll talk more about that in a moment. The discount rate that the Fed lends money to banks and thrifts. So remember, this is a couple different places, but this is called the discount rate, the rate at which the Fed lends money. There's definitely a multiple choice question about that. Ooh, capital. Right. So when you look at this list of Fed functions, start at the bottom and say, okay, this one's the most important. These others are important as well, but ultimately, the Fed controls the nation's money supply to influence interest rates to try to accomplish its dual mandate of relatively stable inflation of 2% and relatively full employment level of 4% unemployment. I don't think, I don't remember. I'll just go over this real quick. This function of the Fed. Uncle Sam needs a place to park its monies because Uncle Sam writes lots of checks. They write lots of checks for defense contracts, for Social Security, for unemployment, right? So when we say this fiscal agent for U.S. government, simply a fancy way of saying that the Federal Reserve provides bank services for the federal government, all right? Okay, we're going to go over this idea, setting a reserve requirement and holding reserves, knowing that currently in the real world, there is no reserve requirement, but this might be reinstituted, so it's a possibility, and it's in the book. So we're gonna go over an example. There's one multiple choice question. It's the last multiple choice question about this idea. All right. Boop, 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 boop. All right, so okay, let's go over this quickly, and then we'll go over that the money market question. I'm sorry, the reserve requirement question. Okay, so the story of the goldsmith, right? I just went over a teeny bit of this, but back in the day, people used commodities as money. The two problems with that is it was cumbersome and it was dangerous. So it was a pain in the butt ski to carry gold around because it weighed a lot, and you had to find somewhere to store it, and it could be easily stolen. So it made sense to take your gold, take your commodity money, park it with a goldsmith, and the goldsmith would protect it, and the goldsmith issued paper currency, and the receipts that represented the gold. So we replaced commodity money with commodity backed money with the paper receipts, right? The next thing that happened was that the goldsmiths quickly realized that they were now in the banking business. Since the receipts were as good as money, they could, if they were a prudent lender and they were smart about the approach they took, they could create monies into the system by granting a loan. So they could grant a loan and increase the money supply. So when the loan was created, money was introduced into the system, new monies was created in the economy. When the loan was repaid, money was destroyed. Now, two final ideas here. Number one, without fractional reserve banking, it's impossible to have loan creation, money creation, money destruction when loans are repaid. So the modern banking system is built on a fractional reserve system. Right now, again, today it's hard to get your mind around this, but there's actually not even a require reserve. The last idea is important though. The reason we don't have bank panics, the reason why we don't worry about your money parked at Bank of America or TD Bank or Wells Fargo is that all banks pay into the FDIC insurance program. So it's not necessarily the fact that you're 100% certain your bank is financially stable. It's that you're convinced your money's safe because of the insurance built into the system. Now, the funny thing is, first time I ever taught macroeconomics, I was explaining FDIC insurance, and I said, "Yeah, there'll never be another run on the bank." And sure enough, that next day there was a situation in Chinatown where a, a lot of new to this country Chinese were told or got information that their local bank was having solvency issues. So literally, you had a line of 2 blocks of Chinese Americans, or maybe I'm not even sure they were all citizens, but they definitely here legally and had bank accounts. They're trying to pull their money out of the bank, and the Federal Reserve at Seventh and Arch there had to bring cash to the bank to like to assure the depositors that that they would get their money. And like the next day, I'm getting got like 10 texts from students. You said there'd never be. I'm like, oh my God, that's so cool. But I guess the people just were not aware of the fact that their monies were insured. All right, so let's go over this because there's definitely that multiple choice question. If you understand this idea and you get this idea, you'll be in good shape for the questions about bank lending, the ability of one bank to um, create money, and the potential money creation of the system. So if you look at any bank and say, okay, let's assume for a moment there was a required reserve. Banks hold checkable deposits from customers. If there's a required reserve, a portion of those deposits are absolutely positively on hold. Basically, they have to keep them in the bank vault or on reserve at the Fed. They can't lend them out. The remaining percentage of checkable deposits are excess reserves and are therefore available for the bank to loan out and then introduce new monies into the systems. All right, so this equation is important. Don't confuse this with the spending multiplier / tax multiplier that we studied earlier, right? So when you look at this, you say, okay, if the Federal Reserve has a required reserve for banks and thrifts, let's assume it's 10%. So bank takes in $500 million worth of deposits from all its customers. That means they have to keep 50 million, 10% of 500 as required reserves. The rest they can lend out, right? So 500 minus 50, that bank, ABC Bank, is sitting on 450 million of excess reserves. But if that bank makes $450 million worth of loans, the banking system in total can actually create more than just the excess reserves of the first bank. And this idea is called the money multiplier. So first, the value of the money multiplier can be found by taking 1 over the reserve requirement or the required reserve ratio. And then if you take the money multiplier times the initial excess reserves, then it gives you what's the total potential maximum checkable deposit or new money creations of the system in total. Now, the example still works well here. This is the old McConnell example. Let's say, okay, what if there was a 20% reserve requirement? 20% reserve requirements. Okay, 1 over 0.2 is 5, right? So there's our money multiplier. Well, Bank A has 100 million deposits from its customers. They're required to keep 20% of that total either in their bank vault or on reserve with the Fed. Therefore, that bank A, is holding 80 million in excess reserves. Let's assume they make an $80 million loan and that customer turns around, gives it to his construction company because that guy, they're going to have a giant facility built. And then that customer takes the 80 million and deposits it in Bank B. Well, now Bank B has 80 million in new checkable deposits. They can't lend it all out. They can lend out 80% of it, or 64 million. That 16 million is required reserves. And you say, okay, first Bank A lent out 80, then Bank B lent out 64, and so on and so on. Theoretically, the banking system could create a total of 400 million in new monies, maximum checkable deposits. Now, again, let's go back to our equation here. We know if the required reserve ratio, right, if this denominator is 0.2, 20%, not centered, but you get the idea. That's right. So if the required reserve ratio is 0.2, 1 divided by 0.2 is 5, right? So let's assume that this number here, a money multiplier, is 5. Initial excess reserves, well, how much was that? 5 times 80. Oh, wow, 400. All right, so basically, you could do it this super long way and just be frustrated as hell, or you can use this nice tidy equation and you can calculate relatively straightforward how much money one bank can put into the system and theoretically how much new monies the banking system in total can create. So I sent this to students. Yeah. So here's some little review problems, and then I put together some multiple choice problems, and at the bottom here, I put together a question similar to the one I just presented with the PowerPoint example. So let's collectively look at number 6 down here. It says ABC Bank has 300 million in checkable deposits. All right, so that's all the money that's been put into the bank by their customers. All right, so their customers have deposited 300 million into ABC Bank. Right, they have $80 million in actual reserves. So they've been in business for a year or two here, right? They didn't open up yesterday. That means currently they have 80 million right now in reserves. But if the reserve requirement is 10%, how much can Bank ABC still loan out? And how much could the banking system potentially create in new monies? Right? So say here it's like, all right, 300 million. That means 10% of 300. That means they have a required reserve of what? $30 million. Right? They have a required reserve of 30 million. How did I get that? It says it right here. ABC Bank deposits 300 million. Required reserve is 10% of that. That's 30 million. Then we use our equation. Money multiplier times excess reserves equals potential money creation of the entire banking system. So ABC can lend out 80 minus 30, right? They have 80 in actual reserves, but they got to keep 30 of it. So therefore, they're capable of creating 50 million in new loans just by themselves. But if we take the 50 and we multiply it by the money multiplier 10, then the banking system can create 500 million in new loans, right? Now, again, where did we get that 10? 1 over the reserve requirement, 1 over 0.1. If the reserve requirement is 10%, the money multiplier equals 1 over the required reserve ratio, or 1 over the required reserve. 1 over 0.1 is 10. 10 times 50. The banking system can potentially create 500 million in new loans slash maximum increase in checkable deposits. Now, some student asked a good question in class. They said, why do you keep saying increase in money or increase in checkable deposits? Remember, checkable deposits are money. If there's money in somebody's checking account, it's money in M1. It's part of the money supply, right? So, if a bank creates a loan and then I get that loan and I go out and I spend it on put it, say, an addition on my house, and then that, the company that I paid to perform the construction, they take that money, they put it in the bank. Now that's new money in that bank, right? Now, this question at the end says, what two assumptions do, must be in place for the banking system to reach its maximum checkable deposits? So this money multiplier equation that estimates the potential increase in the money supply of the banking system is built on two huge assumptions. The first one is that banks lend out all excess reserves. And the second one is that all new monies, all new loans are immediately redeposited into another bank. Now, the multiple choice question on the test is exactly like this, except it just presents the question about how much can ABC lend out and how much can the banking system lend out. So if you review number 6 here, you're in good shape. I don't think there is I don't think there's another. I think there's only one multiple choice question, but it's good to maximize your potential score here. All right, monetary policy. So what is unique about our Fed as opposed to other central banks across the globe? What's unique about the U.S. central bank, the Federal Reserve, relative to the Bank of Japan or the ECB, which is the European Central Bank, Australian Central Bank? Our Fed, our central bank, has what's called this dual, D-U-A-L, dual two-part mandate. The Fed has to look at and monitor and then do its best to keep in check the price level at 2% inflation and the unemployment rate somewhere near 4%. So we already call that full employment domestic output. Other central banks in other countries or economic units like the EU, they only have to worry about the price level. Matter of fact, one of the criticisms of the Fed is that they have too much on their plate. But it is what it is. Our Fed has this dual mandate. They're supposed to do anything and everything within their framework, within their power, to sustain full employment domestic output, meaning 4% unemployment and close to 2% inflation. Now, again, look, if you're sitting there during the review, I'm glad you're here. I appreciate your participation. The next slide is something you should already know. So when you think about, okay, am I prepared for this test tomorrow? Can I right now construct full employment domestic output using the tools of aggregate demand and aggregate supply? In other words, can I use the aggregate demand, aggregate supply model to draw a picture, a framework, a graph of the US economy when we're operating pretty darn close to perfection, where we want to be in the long run when things are not screwy, weird, out of control, messed up, right? So you should be able to draw this graph. All right, so if you're at least thinking about that, excellent. Now, here's the thing about this class. Look, you guys are allowed to use your notes. I remember when I remember because the professor I had was a great guy. I used to go out and have drinks with this guy and his buddy. They were like this went on economic conferences with this dude. He was Dr. Dragonet, Dr. Joseph Dragonet. He was a super brilliant guy. In addition to being a crazy talented economist, he actually got published in a few philosophy journals because he was a good writer. But anyway, I had and this was my fault. I take responsibility. I had to explain graphs to somebody else. In other words, what to draw in on the test. And we didn't have the luxury of using our notes. And I was doing the ISLM model. I still remember this. And for whatever reason, I told the person to put IS on the upward sloping curve and the LM on the downward sloping curve, and they were opposite. And so instead of getting a 99 on the test, I took 15 points off. And I was so pissed because I knew exactly how to do everything. I was so angry, right? But for you guys, there's no excuses. You're allowed to use your notebooks. Make sure you can draw this into onto the test tomorrow. And make sure you are able to comment on what's going on with our three macroeconomic variables at full employment. Right. So when I taught AP Econ, for a while, in high school, there was this service the students had access to where, they had these review videos. And this one woman and this other guy that would be the review, they used to say, ace your graphs. And I'm like, I kind of like that little acronym. So it's axes, curves, right? And E for equilibrium. So on the vertical axis on this graph, we're measuring aggregate price level, aka inflation, right? AKA inflation. So on the vertical axis, we're measuring, we'll call it the consumer price index, right? We could use the personal consumption and expenditure. That's what the Fed prefers, or the producer price index or the GDP deflator. Let's just call it the CPI. So we're measuring inflation. On the horizontal axis, we'll simultaneously measure our other two important macro variables. So macroeconomic variables are important, are real GDP and unemployment. So as we move left to right along our horizontal axis, GDP is increasing and unemployment is coming down, right? So when you look and say, okay, how do I set up this model? Well, you got demand and supply. You got aggregate demand and aggregate supply. Hold on one second. Doot, 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 doot. Yo, don't say anything bad. I'm on a Zoom call with my students. You need something desperately? Doot, doot. No, I know. I'm not down there. Are you down there? Yeah, Summit. I'll call you back in like 20 minutes as soon as I'm done a Zoom call. Sorry, people. I knew she was going down to my place. Just want to make sure she didn't need something desperately. Sorry for the interruption. Okay. So aggregate demand, total demand for all output by all buyers. So look at the downward sloping AD curve. CIGX, consumer spending on durable goods, non-durable goods and services. I investment spending, machines, equipment, tools, factories, refurbishing equipment, all right, new projects, intangible capital like logistic systems or something of that software, government spending and exports, and then aggregate supply. Here's where it gets mildly more, I won't say confusing, challenging, we'll call it. Aggregate supply measures the amount of real output that all producers want to make available at the given price level. And the key idea here is the end at the given price level, right? In the long run, how much production will take place? Think, this is the first night of the class. Limited resources, unlimited human desires and wants. Therefore, when everything's going well in the long run, we'll produce at full employment. In other words, long run aggregate supply curve will be vertical at full employment, straight up and down, meaning small, medium-sized, large-scale businesses will produce the amount that the existing land, capital, and labor can crank out. But that's because in the long run, price level, the aggregate price level, and resource prices are flexible. So there'll be this, nice cohesion among the cost of land, capital, and labor and the aggregate price level in the long run. But in the short run, we have this stickiness or this discombobulates, this disconnect between the price of wages, the price of land, and the price of capital. Mostly wages, right? That's the one that's the most rigid, so to speak. So in the short run, we have this issue, right? In the long run, there's this alignment between resource prices and the aggregate price level. In the short run, wages can be rigid or sticky. So therefore, we have this disconnect between the aggregate price level and the amount of real output, right? So long run aggregate supply curve is vertical at full employment. The short run aggregate supply curve looks like any other supply curve. It's upward sloping, and it shows that relationship between the aggregate price level and the amount of real output that all producers want to make available for sale. As pictured here, everything's perfect. GDP is growing about 2.2, 2.3%. Unemployment is real close to our full employment number, about 4%. And inflation is perfect, right about 2%. Right, so we actually want some inflation. So when you look at this, say, okay, this is always the goal of macroeconomic equilibrium. We're either here or we're working our way back towards here. That's our desire to get back here, right? So this next slide is pretty straightforward, like big picture. All right, what does the Fed do? Two months from now, you're not going to remember all the particulars about, oh, under limited reserves is the discount rate, the reserve ratio, open market operations. With ample reserves, it was, forward guidance and the IOR. Just think FFR, Fed funds rate. Our nation's central bank, the Federal Reserve, they control the Fed funds rate, right? They can't go out and set a dial. They quote unquote manage the Fed funds rate. And it's the policy rate that influences other really important interest rates in the economy. The interest rates that matter in our lives, the prime rate, the 5-year car loan, and the mortgages and student loans. So you should already have a firm understanding of how interest rates affect economic activity. Lower interest rates stimulate spending, higher interest rates stifle spending. Right? So this is pretty straightforward, all this stuff here. Right? Now let's go. I know there's a couple questions about what's sort of going on, you should know what an interest rate is, the cost of borrowing money and the reward you get for lending money, right? There's definitely a question about which interest rate is the rate at which the Fed lends money to banks or other financial institutions who need to borrow money. That's a discount rate. Well, which interest rate is the policy rate of the Fed? That's the Fed funds rate, right? Um, the last one, you know, the newest tool of monetary policy, if the Fed wanted to today increase borrowing or incentivize borrowing by lowering interest rates, they would reduce the amount of interest that the Fed currently pays on reserve balances that banks are holding at the nation's central bank, at the Fed. If the Fed wants to increase interest rates to slow economic activity, the Fed will increase the interest they pay on reserve balances. All right, now let's go over, I know there's a question about, let's do here. Yes. You should definitely know what assets and liabilities are on the Fed's balance sheet. And you should have an understanding of how that balance sheet has changed pre-financial crisis, post-financial crisis, right? So prior to the financial crisis of 2008, the housing collapse, the Great Recession, teaching monetary policy was very simple. Left-hand side, what does the Fed own? Primarily owned short-term government bonds. Right-hand side, what offset the amount of government bonds that the Fed held? Primarily CASH, cash, Federal Reserve notes outstanding. So when you look at the balance sheet prior to the financial crisis, the Fed owned about $714 billion worth of short-term government bonds. That's what we mean by securities. And that was not perfectly offset by, but closely offset by cash in circulation, $778 billion, right? So the Fed's balance sheet in total was about $800 billion, 885. Right? And when you look at this nice little chart of the Fed's balance sheet, you can see that reflected. Where the hell is it? Here it is. Here's the Fed's balance sheet. Oh, no, that's reserve. Sorry. There we go. All right. So here's a chart of the Fed's balance sheet before and after the Great Recession. So just look at this period from 2003 through 2009. You can notice that the size of the Fed's balance sheet didn't change much. And then, I couldn't find one that goes back further on the Fed site. So I went ahead and I borrowed one from somewhere else. And you can go back, it was that way from like 1960 all the way 2008. The Fed's balance sheet was, it was less than $1 trillion, somewhere between 500 billion and a trillion. So it didn't change much. And then what happened? They said, okay, the Fed has this policy tool, the Fed funds rate. And we already know it's the most important interest rate because it influences the interest rates which matter in our lives. So generally speaking, it's a pretty straightforward relationship. During an economic boom, the Fed raises the rate to keep the US economy from having a situation where too much money is chasing too few goods or inflation is an issue. During an economic bust, the Fed does the opposite. They lower the rate. And you can see this, the relationship between economic good times and bad times and the Fed funds rate from 1955 all the way through the financial crisis. Every time there was a recession, the Fed would lower the rates in response to an economy that was struggling. Anytime there was inflation, the Fed would increase the rate to try to bring down undesired inflation. But what happened in 2008 was crazy because Fed lowered its policy rate, the Fed funds rate, from 5% all the way down to zero. And it was rather evident that we were still in economic disarray. The economy was still reeling, unemployment was 10%. Right? The fiscal policy response was massive, but we were still in a pretty darn bad spot. In response to this unique and unprecedented economic downturn, the Fed decided to try something different, right? Because prior to the financial crisis, the primary weapon of the Fed was what's called open market operations, buying and selling government bonds. buying and selling short-term government bonds. That was the Fed's primary tool. That's how the Fed managed their policy rate, the Fed funds rate. But after the financial crisis, in response to the Great Recession, the Fed introduced a new tool into the arsenal called quantitative easing, or the purchase of mortgage-backed securities, which they had never owned before, and long-term government debt. So the red on this chart represents mortgage-backed securities. The blue says Treasury securities, but it doesn't break it down and tell you that in addition to buying the 1 and 2 year Treasury bills, now they were buying 7, 10, 30-year government bonds. So all of a sudden, the Fed took a new approach to managing the economy by purchasing mortgage-backed securities that nobody wanted because of the brokerage houses and brokerage firms collapsing, and long-term government debt as a way to just put massive amounts of liquidity into the system. Now, look what happened to the Fed's balance sheet because of the quantitative easing. You can see this, whoa, vertical jump here. Then it kept rising. The Fed's balance sheet went from 800 billion to 4 trillion. And then like, okay, well, maybe things will start to normalize little by little over time. And I remember reading in 2019 the articles about like, okay, the Fed's going to start quantitative tightening. Right? They weren't going to go out and sell all those mortgage-backed securities or sell those long-term government bonds, but they were just going to allow them to mature. They'll just hold them until the bond came due, and little by little, the Fed's balance sheet would ultimately maybe make its way back towards normalcy. And then the darn pandemic, and like, okay, if this interesting novel approach to monetary policy worked, at least to some degree, to rescue the economy from Armageddon in 2009, let's try it again, but on even a more massive scale in response to a once in a century pandemic that totally disrupted the economy, right? Now, because of that new tool, quantitative easing, the entire approach to monetary policy changed. Now, here's the thing. I'm going to go over this quickly because I know there are no questions or multiple choice about this, but we went over it in class. We went from a system of this, limited reserves. So when you look at this graph of the money markets, which has your demand for money and your supply of money, right? This is exactly, or highly similar to this graph we were talking about right here, right? The money market. Now this was it. It was very simple to explain. So, okay, when you want to figure out how the Fed institutes monetary policy, they would make small changes in the supply of money to affect the interest rates. So here we have the what? Quantity of money supplied and demanded. Vertical axis, we have the interest rates. Now on this graph, they label it FFR, Fed funds rates. So before the financial crisis, the Fed could manipulate the reserve requirement or change the discount rates, but most likely they're going to do this open market operations. Now there is a multiple choice question about that. So what do we mean by open market operations? Straightforward. The Fed buys or sells government bonds, which will affect interest rates, right? The Fed buys and sells government bonds. That's all we mean by open market operations. So this was really easy to teach before the financial crisis. Said, yeah, the Fed could change the required reserve ratio. Probably not going to happen. They'll use this, the discount rate, as an announcement effect to where they're headed with monetary policy, but they're basically going to use open market operations. So when you look and say, okay, this is the world we lived in before the financial crisis, it was simple. If the Fed was responding to a recession, they'd want to push the money supply slightly to the right to push down interest rates. So they could buy bonds from banks. The banks would get this infusion of cash. The banks would have new excess reserves. The money supply would increase and interest rates would come down. If the Fed was worried about inflation, the Fed would sell bonds to banks. Banks would give up their cash or excess reserves. There'd be less money supply. Interest rate would go up. All right. Now we work with a system of what's called ample reserves. Right. And we looked and said, geez, this is the amount of reserves in the system. From 1960 all the way through 2009. Like this is a blip on a radar. Now it sounds like a lot of money to you and me, but we said like, I know the most that was ever in there was 45 million, sorry, 45 billion. Before the financial crisis, there was 15 billion in total reserves in the banking system. But then after the Fed bought all this treasury securities, long-term government debt, and all these mortgage-backed securities, all the money that the Fed put in there ended up as reserves in banks. So reserves shot up all the way into the trillions. So no longer do we operate with limited reserves. Now we operate with ample reserves. And so you can see that by changing the money supply a little bit, it will have absolutely no effect on the interest rate or the policy rates. So the Fed now manages the money supply by changing the interest they pay on reserve balances to either increase or decrease their policy rates, right? Now, I think there is one multiple choice question about that, the idea that, if the Fed wanted to respond to an economic downturn and it said something about like, they would decrease the amount of interest they pay on reserve balances, or it could say the opposite. But what you absolutely do need to know is the cause and effect relationship of Fed actions. So let's start by revisiting something we taught when we did fiscal policy. I look at this and say, all right, what's going on now? I know it's pretty easy because it's right there. It says it up top. All right, recessionary gap. So something has caused aggregate demand to shift to the left. So we were at YFPLE. Here was our equilibrium macroeconomic situation. We had unemployment of 4% with a nice GDP growth of around 2.2%, 2.3, and we had perfect inflation of about 2%. Then something caused consumer spending and investment spending to drop precipitously. So we have this leftward shift in aggregate demands. It's called a recessionary gap because we'd like to be producing this amount of real GDP, but now at the new equilibrium, economic output has fallen below potential. We have a recessionary gap. That means if we're not here at YF, we're all the way over here at YE1. That means we have what? Cyclical unemployment. Definitely not worried about price level because inflation is not the problem. Aggregate price levels actually come down some. Now we learned that, yeah, the federal government could cut taxes, increase government spending, increase transfer payments. That would definitely do some good for the economy to get us back towards our full employment goal. But what can the Fed do? What can our nation's central bank do? This slide gives you that list of how the Fed should respond to a recessionary gap under both the system of limited reserves and the system of ample reserves. Now, the nice thing is you could just copy this into your notebook and you could look all fancy and say, like, I know all this stuff on how the Fed should react to this economic dilemma. Right? The economy has contracted, unemployment's way above 4%, GDP is faltering, not worried about the price level. But if you just look down here, this is the most important idea. All right, what will the Fed do? The Fed's going to say, look, we got to put liquidity in the system. We got to increase the money supply by using our tools to affect our Fed funds rates. So the Fed's going to, in response to a recession, they're going to institute not expansionary fiscal policy, expansionary monetary policy. So they'll put more liquidity, more money in the system. That will push down the interest rates, right? Obviously, when you say interest rates, it's going to start with this. It's going to start with FFR, the Fed funds rate. The Fed will manage its policy rate downwards, and that will push the rates that matter in our lives downwards. So hopefully when the Fed pushes down interest rates, it will entice some consumer spending and investment spending, and consumer borrowing and spending and investment borrowing and spending. That will shift aggregate demand towards the right, and then GDP should pick up somewhat, and that should bring the unemployment rate down somewhat, right? Now, it's also nice here, you have the same idea, right? Recession, increased money supply, interest rate falls. Remember, mention FFR, Fed funds rate, and then more investment in consumer spending. Aggregate demand goes up, real GDP increases, and unemployment falls. Now, we could have the opposite problem, right? So this has happened many times in our economic history where we got too much money chasing too few goods. As pictured here, we got what? Real GDP is running too hot. So when we did this, this was way back, we talked about that guy Ocon's razor. I'm sorry, Ocon's law. And we said, geez, there could be a time when actual GDP is exceeding potential GDP. And that could cause a situation where price level has gone above our 2% target and could be significantly above. So we started at equilibrium here. 2% inflation, 2.3% economic growth, 4% unemployment. And then aggregate demand shifts rightward. The distance between Y1 and YF, that's the inflationary gap. Now the Fed doesn't like having its reputation as the institution that's responsible for price control being questioned, like everyone was worried about in 2022. Like the Fed says, I'm sorry, people are saying in the econ community and finance community, how could the Fed let inflation get so high? So the Fed's going to institute contractionary monetary policy in response to demand pull inflation. Again, here's the particulars. Whether it's limited reserves or it's ample reserves, you need to know the basics, the straightforward idea. The Fed wants to push up its policy rates. How do they do that? They will decrease the money supply to put upward pressure on interest rates. Where do they start? All right, they're going to start by increasing the FFR. So if it was limited reserve systems, they would raise the discount rate, raise the required reserve ratio, or sell bonds from banks. If it's ample reserves, they could have negative forward guidance saying, hey, we're pushing up interest rates, or they could quantitative tightening, but most likely they're going to use the primary tool. They're going to say, all right, we're paying more interest on reserve balances. All those policy maneuvers will push up the Fed funds rates. That will take money out of the system. Interest rates will rise. Consumer borrowing and spending will get less attractive. Business borrowing and spending will get less attractive. Aggregate demand should shift to the left some. That should bring down the aggregate price level. Now, you might be sitting there going, yeah, but wouldn't that actually contract GDP? So if the Fed's successful at shifting aggregate demand in the opposite direction of these arrows, like we know the arrows cause the problem. Too much money chasing too few goods. The rightward shift in aggregate demand beyond full employment domestic output, that caused the demand pull inflation, the inflationary gap. What if we overdo it? And that is one of the good questions, and also difficult policy maneuvers for the Fed. That idea is called a soft landing. The idea that the Fed wants to put the brakes on, but they don't want to slam the brakes, right? They want to just slow the car down to a reasonable, speed. And there's been so much written when we had this inflation in 2022 that the Fed waited too long, and now they pushed interest rates up so quickly that we're going to have a recession. Well, again, there's no perfect playbook here. Even doctors sometimes are a little bit worried about some of the maneuvers they perform in response to somebody's health. So when you look and say, geez, yeah, when the Fed realized that there was, where the heck is this slide? When the Fed realized that there was out of control inflation in 2022, they pushed the Fed funds rate up from 0 all the way up to 5%. And it was the shortest, steepest incline in, like 50 years or something. But knock on wood, as of right now, we've continued to have an expansion without overdoing it, pushing the economy into recession. All right. I know there's another question about two more things. First, there's a multiple choice question about this. Where is criticism to the Fed? Here it is. Evaluating monetary policy. All right. So this idea of cyclical asymmetry, what does that mean? I mean, when we evaluate the Fed and we say, is the Fed perfect? Well, no institution is perfect. This isn't a criticism of sort of, you know, a particular action of the Fed. It's more a criticism of the Fed only being able to affect interest rates, having this blunt instrument of impact on the economy, and the sort of shortfalls of their only policy tool. Cyclical asymmetry means, you know, the Fed's pretty darn good about reining in inflation. If the Fed wanted to, it can soak up enough liquidity out of the system. It can shrink the money supply to push interest rates up to really make it challenging to borrow and spend, to really discourage buying cars and refinancing your house or buying a house, or make it really almost impossible for businesses to find a situation where the expected rate of return on a project is greater than the real rate of interest. So the Fed's pretty good at to decreasing inflation, or we'll say reining in inflation during those economic uh, problems. But what about during a recession? Well, even during a severe economic downturn, I should say during a significant economic downturn, people aren't going to feel altogether tremendous about borrowing and spending if they don't have a rosy picture about their economic and financial future, especially on the business side. So when you look at, you know, the the financial crisis and the lack of forward guidance for businesses, they're really worried about, when is this Great Recession going to subside to the point where we feel good about purchasing more equipment or expanding our capacity or even refurbishing the machines we already possess. So this idea, you can lead a horse to water, but you can't make him drink. Cyclical asymmetry. The Fed's really good at reining in inflation, but they can't make businesses borrow and invest, and they can't make people borrow to spend, right? All right, I'm trying to think if there's anything else I forgot to do. Not really. Right. Now remember, 50% of the test is right there for you. So literally, if you what is it, slide 54? If you look at slide 54, actually let's call it 54 and 55, and those are explanations of how to respond to demand pull inflation slash inflationary gap. And slides 49 and 50 that explain proper monetary response and the cause and effect usage of expansionary monetary policy. That's guarantee you'll do well on the last FRQ, the third free response question. If you watch the videos for the inflation video and the 2% inflation video, I should say, and the video about how and why right now the Fed is operating at a loss, you have all that stuff. That's basically 50% of the test. That gives you a lot of cushion for a few of the tricky multiple choice. Now, I have to be honest, I think these multiple choice are the most straightforward of all three tests. Now, I know that, you're like, well, you see this stuff all the time. So it is, I do make that mistake where I'm like, oh, I think these are relatively easy. But I have a feeling that people are going to do okay. They're going to feel better about the multiple choice than maybe they thought they were going to do on the multiple choice, right? So any other questions, please hit me up. I got till what? The test is 3:30 tomorrow, and I was wrong on the time. So I'll probably arrive at campus a little bit early if anybody wants to get started early. I don't know if that room will be open. That's the only issue. All right, people, thank you for listening. I'm going to as soon as this is as soon as this is ready, I'm going to post this recording on Canvas for our course. Maybe I'll even make a YouTube link, make it easy for people to access. All right, if you need anything between now, by the way, I'm almost done grading the Economic Analysis 5, and I'm going to work on some of those presentations as well tonight. If you need anything between now and tomorrow, hit me up. Otherwise, thank you for listening.